Just 14 months ago, Meta Platforms, the once mighty social media behemoth, stood at the pinnacle of success. Once known as Facebook, the company which also owns Instagram and WhatsApp was on top of the world. Its stock soared to a staggering $383 a share, and the company's value reached a mind-blowing valuation of $1.1 trillion. Mark Zuckerberg, the prodigy who founded Facebook in his college dorm room at the age of just 19, had turned his vision into the 6th largest listed company in the world, and his net worth skyrocketed to a whopping $145 billion. But little did Zuckerberg and his team know that their downfall was imminent, and that just 14 months after reaching the peak, on November 3rd, 2022, the stock was trading below $90 a share, a decline of 76% and a level last seen in 2015, 7 years prior. So what exactly happened over this 14-month period? Well, in this video, I will give you a very concise breakdown of the events leading to this tectonic shift in investor sentiment, including the biggest one-day drop a stock ever experienced in US stock market history. Alright, so we'll start in 2021. In late July, the company that back then was still named Facebook reported its second quarter numbers, and it's no secret that Facebook and its social media apps were major beneficiaries of the COVID lockdowns and the global pandemic. Facebook's revenue grew an astonishing 55% year over year. Operating profits grew 107%, and Facebook's operating margin stood at a whopping 42.5%. So it was no surprise that investors' sentiment was euphoric, which eventually led to Meta's peak valuation of $1.1 trillion in early September. But then, towards the end of the year, things slowly started to change. In Q3, growth already slowed, leading to a declining share price. And then in October 2021, Facebook competitor Snapchat suffered a record decline and dropped 26.6% during a single trading day after posting disappointing numbers. And the stock prices of other online ad companies like Facebook and Google also dropped along with Snapchat. And later in October 2021, Zuckerberg also announced at the Facebook Connect conference that the company is going to change its company name to Meta, which was supposed to reflect Facebook's growing ambitions beyond social media and Zuckerberg's vision of becoming a key player in the emerging metaverse space. Zuckerberg wrote in a letter to shareholders, "Today we are seen as a social media company, but in our DNA we are a company that builds technology to connect people, and the metaverse is the next frontier, just like social networking was when we got started. To reflect who we are and the future we hope to build, I'm proud to share that our company is now Meta. From now on, we will be Metaverse first, not Facebook first." And of course, some investors were excited about the name change, as we were still in the middle of the 2021 bull market. But others were already back then more cautious, highlighting that the concept of the metaverse is a very theoretical one as of now. It may take years to unfold, and it will most certainly require massive amounts of capital investments. In fact, during the Q3 2021 conference call, one number stood out: $10 billion. This is how expensive Meta's metaverse ambitions were estimated to be, and Zuckerberg even said that he expects these investments to grow over time. Quote unquote, "In 2021, we expect these investments to reduce our overall operating profit by approximately $10 billion. And I expect this investment to grow even further for each of the next several years." And things got even worse after the now rebranded company Meta reported its fourth quarter results in February of 2022. During the trading day, before reporting their numbers, February 2nd, Meta shares were still trading at a comfortable $328 per share and were only down 15% from the September peak. But they then reported their fiscal year results, which, with the benefit of hindsight, can be identified as the turning point in terms of the sentiment of Meta investors. Before we take a look at the share price development following this report, let me just point out three key numbers and developments. First, the headline revenue number wasn't actually too bad. Revenue still grew 20% year over year, but Meta's operating margin started declining, and operating profit actually declined year over year. Secondly, Meta experienced year over year declines in ad impressions delivered in the United States and in Canada, which added to investors' worries about increased competition from TikTok, which seemingly was a much stronger competitor than Snapchat was a few years prior. This was then emphasized by Mark Zuckerberg himself during the following conference call. He said, "But there are two things that I want to call out that are having an impact on our business. The first is competition. People have a lot of choices for how they want to spend their time, and apps like TikTok are growing very quickly." Zuckerberg also highlighted that this new form of content, short-form video, requires a different way of advertising to achieve high returns on ad spend, and that this is something that Facebook and of course also advertisers would need to figure out. And the final number was once again $10 billion. This time, this number represented the estimated iOS ATT headwind that the then CFO David Wayner announced. To quote him here, "We believe the impact of iOS overall as a headwind on our business in 2022 is on the order of $10 billion. So it's a pretty significant headwind for our business." So how did the stock react to this news the next day? Well, the next day, Meta dropped 26% at the open to $237 a share, with investors bitterly disappointed by the results. Meta's market cap lost about $237 billion in value overnight, the biggest one-day drop in US stock market history. And investors were also shocked by the capital allocation decisions made by Meta's management team. Zuckerberg and his team must have known that their Q4 results were pretty bad and would likely lead to a stock price decline. Nonetheless, they repurchased almost $20 billion of shares during the quarter, which further confused investors. And so it comes as no surprise that in the subsequent month, Meta's stock continued declining to around $187 a share in early March. Basically, the following month, the financial results continued to be outright disappointing, and the numbers might have been even worse than, Meta's biggest critics might have expected. Revenue growth slowed further and eventually turned negative. In fact, the revenue decline Meta reported in Q2 of 2022 was the first time the social media giant's revenue had fallen ever since its IPO in 2012. The company continued to face increased regulatory scrutiny, a turbulent economy, a slowdown in digital advertising, strong competition by TikTok, ATT headwinds, and even Android announced privacy changes that would further impact Meta's traditional ad targeting business model. And despite all of this, Zuckerberg was committed to the metaverse. CapEx investments continued to increase, and Zuckerberg even publicly said that investors should anticipate Reality Labs losses to be further ramped up. Operating profits declined 4 quarters in a row, and Meta's operating margin declined from 45% in late 2020 to just 22% in 2022. Meta's free cash flow development was even worse, as Meta generated just $300 million in free cash flow in its third quarter, posting a meager free cash flow margin of just 1%. And this is actually before subtracting stock-based compensation. Put differently, the public perception was that Meta turned from a cash flow machine with high margins into a cash burner, with a CEO at the helm who's obsessed with his metaverse ambition. After reporting their 2022 Q3 numbers on October 27th, Facebook's stock yet again dropped by more than 24% in just a single trading day, from around $130 a share to below the $100 a share mark. Meta's market cap was now well below $300 billion, and all gains shareholders enjoyed after 2015 were essentially wiped out. The aforementioned macroeconomic as well as industry-specific headwinds were still present, but Meta showed no sign of slowing down their metaverse ambitions. In fact, between 2019 and September 30, 2022, Meta is estimated to have flowed $36 billion into Reality Labs, and CFO Wayner still said, "We do anticipate that Reality Labs operating losses in 2023 will grow significantly year over year, which would lead to further margin contraction." But anyway, the decline below $90 a share marked another turning point, possibly the bottom of the historic share price decline Meta experienced. A lot of things happened in the 3 months following this report. First of all, at the bottom, Meta's stock was just getting absurdly cheap. Depending on where you see steady state operating and free cash flow margins, Meta was trading below 10 times those profit metrics. You don't even need a discounted cash flow model to figure out that investors were basically pricing in no growth at all and basically expected Meta's business to decline. I would say typically only declining businesses in declining or deteriorating industries trade at such low multiples. Secondly, on October 25th, in an open letter to Zuckerberg, Brett Gerstner, the founder of Altimeter Capital, urged Zuckerberg to change course and argued that Meta had, quote-unquote, drifted into the land of excess, too many people, too many ideas, too little urgency. And this, quote-unquote, lack of focus and fitness is obscured when growth is easy, but deadly when growth slows and technology changes. And thirdly, in early November, Zuckerberg then eventually announced that Meta will lay off 11,000 employees, or about 13% of its workforce, across virtually every department, after aggressively hiring more than 27,000 employees in 2020 and 2021 combined. Now, I think the story of Meta's spectacular 76% stock price decline can teach investors a great lesson. Ever since the share price bottom in early November, Meta stock is up more than 56%. Investors are all of a sudden much more optimistic about Meta's business, and it shows how much share price developments influence how a business is perceived by the public. Remember, price drives narrative, because this idea refers to the concept that the direction and movement of a stock's price can influence the way that the asset, in this case the stock, is perceived and discussed in the public markets. Put differently, when the price of a stock goes up, people are more likely to see it as a good investment and talk positively about it, while a falling share price can lead to negative investor sentiment and a bearish outlook. This will also include how the media covers the stock and financial markets, with positive price movements leading to a more positive coverage and negative price movements leading to a more negative media coverage. What helps is to focus on the fundamentals of the business only. Let me just share with you a short sequence of Robert Vinal's most recent investor meeting, during which he and his partner Andreas shared how they view the current development of Meta's actual business. And I think what you can learn from them, speaking about Meta and the business development here, is how you can focus on the business itself, regardless of what the share price performance is doing in the short and medium term.
I would say, on balance, I would say I'm maybe even more bullish today than I was then. If I go back to March, ATT, which was the main thing which has harmed Facebook over the last 2 or 3 years, was already well established. It was clear that was going to negatively impact its cash flow. But I think from the perspective of last March, the biggest fear I had was around sort of TikTok and the potential for TikTok to take engagement away from the Facebook family of apps. And in that respect, I think the market share gains of TikTok have flattened, and I think Facebook is having incredible success with Reels. I saw that it's, I think 20 or maybe even 30% of page impressions are now Reels, which haven't yet started to be monetized. So, I would say that's one where I'm still pretty optimistic. What about you?
Yeah, and what we've seen so far is Apple's action of disabling or requiring consent to tracking, but we have not seen Facebook's reaction yet. So they are rebuilding the advertising stack right now. They are investing in AI. Much of these data center investment that they have planned for last year and this year, 30 billion last year, 40 billion this year, 70 billion in total, are going into AI capacity, which help with analyzing the videos in the Reels, so what topics are they on, tagging them, and matching it with ads. So I'm quite optimistic that something great will grow out of that. I think the AI capabilities within Facebook or within Meta are nothing short of what we see at OpenAI with ChatGPT, but they just don't use it for a chatbot, they use it for advertising placement.
So what you can learn from the two here is that you should analyze how a business develops fundamentally, regardless of the share price performance. The two discussed ATT, how Meta has reacted to this challenge by building its own in-house tracking capabilities and invested heavily in AI, and whether TikTok really poses a threat to Meta as a competitor. For instance, Vinal highlighted that TikTok wasn't able to take away further market share from Instagram Reels, which is confirmed by this Morgan Stanley chart based on Sensor Tower data. It is showing that time spent on TikTok has actually plateaued. And this is what investors should focus on and not what media headlines report when the general investor sentiment is already at a decade low. Now there's actually more you can learn about the current development at Matter. I suggest you either watch one of my other videos on Matter's business or you watch the entire Robert Vinal podium discussion in which he and his partner share all of their thoughts on Matter starting at around the 33-minute mark.